My name is Teresa Liu from the Secretariat of Asian Bankers Association, the ABA. I will be your MC today. On behalf of the ABA, Rizal Commercial Banking Corporation, and Hatt National Bank, I would like to welcome you all to the second day of the virtual 38th ABA General Meeting and Conference. Now we are ready to begin with session 2, which will focus on the topic Asian banks navigating through a digitalized environment. And now may we invite the chairman of session 2, Mr. Rajendra Theagarajah, member of the ABA Advisory Council and former ABA chairman, to kindly make his opening remarks and start the session.
Morning from Colombo and good afternoon, I guess, to all of you from Taipei. Today we have for this session 3 very eminent speakers with quite diverse backgrounds. In the order of them speaking, let me first briefly introduce each of them. Mr. Wayne Lai, Chief Digital Officer and Partner of Advisory Services, KPMG, Taiwan, who will speak on building a true customer-centric connected bank in the digital era. He will be followed by Mr. Christophe Uzureau, I hope I got that right, Christophe, a Vice President Analyst of Gartner, a very well-respected think tank and firm in financial advisory services, on how the banking industry can create business value from the Metaverse. And then finally, Ms. Jaslyin Qiyu, Head of Client and Digital Channels Marketing, Citi Bank, Singapore. So without further ado, let me first invite Wayne.
Thank you, Mr. Rajendra. Hi, everyone. This is Wayne from KPMG, Taiwan. I'm currently the CDO of KPMG. It's my pleasure to have the presentation today. Today's topic of mine is to build a trust, customer-centric connected bank in the digital era. Before jumping into the presentation, allow me to turn off my camera first in order to control the networking stability. Okay, you can see my face later on after the presentation. Okay, yeah, okay. So today's topic mainly, next please. In today's presentation, I will spend some time on talking the emerging market trend from global perspective. Then I will share KPMG's methodology regarding the ways to build a customer-centric bank. Finally, I would like to illustrate some case sharing for today's ending. Next, please. Next, please. Okay, let's begin from KPMG's CEO survey. Okay, I quite like this survey. In recent years, everyone should know uncertainty is the only certainty. In order to bring some clarity to the complex world, we interviewed hundreds of CEOs from many of the world's largest companies and trying to get their perspectives and understand of how their priorities have changed. We asked them about what's their confidence about the future, what's their point of view regarding the crisis. Not surprisingly, the CEO we interviewed in the study, most of them are a little bit pessimistic about the global economic situation. So overall, we try to categorize their feedback into 3 key themes. We categorize them as purpose, prosperity, and priorities. The first one is purpose. In the crisis, many of them and their family are affected by COVID-19. Yeah, so it's dramatically change their thinking, their thoughts. So 79% of them say that they have a stronger emotional connection to their organization's purpose. And they also change their strategic response to the pandemic as a result. They think they should be more focusing on creating a trusted purpose for organizations to address critical social challenges. And the second one is prosperity. Although the confidence of them is about the future is not that high, I think they still tried their best to find a way out. And I think the best way is to accelerate the speed of digital transformation for future prosperity. And the third one is priority. The priority mainly into three parts. The first priority of them is ESG. The CEO told us that managing climate related risk will be one of the most important jobs in the next 5 years of their career. And the second topic is about the future of work. 77% of them say that they would like to continue to build on a digital collaboration and a communication tool. And more than 70% of them say they are looking to change their recruitment strategy because remote working has widened their potential talent pool. And the company need to rethinking their office space as well in the short term. And the third one is customer-centric supply chain. Nearly 70% of respondents say that they have had to rethink their global supply chain approach, given the disruptive impact of pandemic, driven by the desire to become more agile in response to changing customer need. Next, please. And under this new normal, I would like to share some interesting figures from consumers, especially for their digital behavior. Okay, under the new normal, we can see a digital savvy customer emerges. Okay, we can see online purchasing and contactless payment options have become the norm for most customers. They believe that they will use cards and digital wallet options more than cash for future purchases. According to our survey, as you can see from the left-hand side, under new normal, the willingness of using new payment method like a debit card, credit card, digital wallet, they all have nearly double-digit increase. And organizations will have to consider releasing cash from existing channels and shifting into digital. And of course, reviewing their digital security strategy and policy will be vital, will be a key. As we can see from the left and the right-hand side, it's more about the channel behavior. COVID-19 has amplified the needs for ease access to product and service and relevant information. The majority of customers are now comfortable using online channels, reducing physical purchase occasions, and they are moving toward touchless shopping and contactless payment. In that chart, we can find customers' willingness for traditional channel, as you can see from the right-hand side top, like stores, branch, decreased dramatically. Instead, touchless digital channel like app, website, and WeChat are growing even 3 times than before. So those changes are really, really big. Next, please. And in this slide, I want to talk about the demands from customers, especially for digital banks. From the previous slide, it's easy to imagine that consumers are keen to use and try new channels. Now, in retailing banking sector, the situation is similar and the same. And trust and digital security is their top priority when using banking service. Okay, the trend of trust is directly beneficial. Is directly benefiting new and digital banks. Our respondents say that their confidence of new banks and the digital banks are even double than traditional established banks, as you can see from the chart. The willingness of new banks is about 25%, and the willingness of digital banks is nearly 24%. So the difference between established bank and new banks is nearly 2 times. Okay. Increasingly, it's very interesting when we ask, are you more likely to consider switching banks in the future as a result of COVID-19? What kind of banks do you think you are most likely to switch to? You can see from the right-hand side. 11% of our correspondents, they say they are considering to switch their banks during COVID-19. And in this group, nearly 14% of them want to move to digital bank directly. Okay, next page, please. So let's talk about how what's the ways to build a customer-centric bank. Next, please. Let's look at the signal and the driver of change in the banking sectors. Banking faces a more complex environment than perhaps ever before. We think the future banking landscapes should include 3 categories, and we strongly encourage bankings to take it seriously. The first is bank needs to have more deep understanding of customer than before. Customer, they really expect instant, seamless, omni-channel banking. In the demand of banking services embedded within corporate process has risen. Banking are also facing pressure for product and service innovation to keep up with the fast pace of change. Another one is data and the digital technology. I think the adoption of cloud and API technologies, AI, machine learning could be vital. Also, distributed ledger also shows potential in banking as well. And creating value through data definitely will differentiate them from the competition. However, I have to say, such transformation to really rely on a capable workforce. So how to make your employee, how to make your working partners to be more capable, to make them get digital capability could be very important as well. And the third one, I want to talk about trust. It's more about how to show their care, how to show as a bank, do care people, how do you react to the fast changing world. The topic into trust, including ESG, cybersecurity, and how to protect the data customers' data privacy. We all know a sound reputation is not that easy to build, but could be destroyed just in one day, especially in the internet world. We know people just put their comments on the internet directly, no matter is it wrong or right, they just do it. So how to face their comments, how to manage it, or how to well react could be very important. People will think more about can I trust you? Can I trust this brand from different channels? So it could be very important. Next page, please. So as such, we think there are 3 future business models for banks to evolve. The first one is a reimagined digital bank. I think for those business model is especially for those traditional banks. We think they need to transform into fully connected digital banks. They need to leverage in their capital and the data while commercializing traditional cost center through rebounding those services, which means maybe you have an old legacy system, maybe your people are not that capable, maybe your system a little bit old, but you should try to learn how to make yourself more digital. You should try to build a little bit digital channels. You should try to use your app. You should try to design some user experience to make your digital customers to be satisfied, something like that. And the second one is bank as a service, or say banking as a service. It's more like an embedded finance perspective, which means bank need to develop and license services and products and manage user interfaces to provide banking service to end users through external partners, or we say through working together with your external partners. You should put your service to other players' platform. You should let them connect or bridge you very easily via API, something like that. And that's the second model we suggest. And the third one is, as a bank, you just be the platform provider, which means the banks to develop an ecosystem by providing, maintaining, or policing a banking platform for other ecosystem player to join. Many people like to ask me, are those three models in silo, or you just need to pick one in the meantime? No, we don't think so. We think they should be blended and combined together based on your strategy. So there's not only one best solution on this, okay? And the other important thing I would like to highlight is that the future of banks must gradually move to open and cloud-based instead of closed and on-premise based. Indeed, even Microsoft or those technology giant, I think they would not support on-premise environment in the long run. So I think it's an inevitable trend you have to adopt. So it's time to learn it. Try to fail. Try to learn lessons from those new technologies. It's also very important for banks. Next, please. Yeah, so now I want to introduce the connected enterprise methodology. During the pass of time, my clients, they never stop asking me how to get the things right. So I always propose the connected enterprise, which is a customer-centric, enterprise-wide approach. We try to use this methodology to link front, middle, and back office to accelerate banks' journey for digital transformation. It's very important to link front, middle, and back office together. So under this philosophy or under this methodology, high levels methodology, we define 8 clear capability for connected enterprise. And according to our research and the survey result, we find that organizations, if they with those 8 capability, if they are mature in this 8 capability, they can perform better than their competitor even 2 times. So some figures to support you should adopt this methodology. So let me spend some time to go through those 8 capability, as you can see from the right hand side. Okay, the first capability is about the innovative product and service. Yeah, it's not a jargon, but you have to develop compelling customer value proposition on price, product, service to engage most attractive customer to drive profitable growth. For example, for pricing, if you are taking an Uber, it's kind of dynamic pricing according to your needs, according to your situation, according to the weather. So now, can you innovate your product for banking via dynamic pricing? Of course, you can do that, but if do your customer want to buy? Yeah, so it's interesting. The second one is insight-driven strategy and actions. Yeah, yes, it's about data. It's about advanced analytics. It's about actionable insights within a real-time understanding for customer and the business. What I want to highlight here, data should not be owned by only one single department. For example, HR, human resource, finance department, do they need to have analytic capability? The answer is yes. So it's not just only for precision marketing, not just only for pricing, for product innovation. I think every function should be with analytical capability. And another one is experience centricity by design. It's talking about how to make a perfect and excellent customer experience. Another one we want to highlight is about employee experience. We think without the employee experience, you will not have great customer experience. And the next one is responsive operation and supply chain. Is more about how to operate the business more efficient and more agile. And another one is to integrate partner and alliance your ecosystem. We mentioned that before. And the next one is a seamless interaction and commerce, which means not your online and your offline channel. you should integrate them as a whole. People should not and should get into your channel easily. They don't need to care about is it online or offline. What they need is just service itself. So let them feel seamless could be very important. And the next one is about your workforce. Can you empower them? Can you let them feel to be respected? Are they capable for those analytic capability, digital capability? Can we help them on that? And the last one is about technology architecture. We mentioned that before already. So those are the 8 capability I would like to introduce here. Next, please. So now let's try, let's spend a little bit time to see some cases. The first one I would like to share is Commonwealth Bank of Australia. Okay, we call it CBA. CBA is using digital technology to create ecosystem for their customers. So first of all, we think their strategy is to focus on value creation. CBA is currently using their existing strengths to create new value for their clients. Now, today, they have nearly 16 million customers and is the largest provider of home loans in Australia. That gives them deep insight of what homeowners need. Earlier in this year, they partnership with Amber. Amber is an energy retail startup company. Amber try to help homeowners tap into renewable energy. So when working together with Amber, CBA introduced a 10-year fixed rate green loan with a very super low rate to help those homeowners to install clean energy products like battery packs, etc. And they can enjoy a super low rate. They can also have do something to protect the environment. So it's quite things like win-win strategy. Okay, the second one is CBA has been making similar investment across a range of vertical central to lives of their customers. So they partnership with Little Bridge is an e-commerce company. It also team up with Cargo, it's a carbon tracking and offset app. So CBA also built an API technology and a world-leading customer engage engine. We call it CEE. CEE is kind of their machine learning platform. They build more than 400 data model and they collect more than 150 billion data points to generate deep customer insight. So besides those 2 strategies, CBA also have 3 key themes as their heart of DNA. The first is that they always spend time to listen to their customers. And the second one is they always create their dynamic partnership strategy. They review the partnership with those partners dynamically along with the needs of the evolution of customer. And the third one is data. We talked that already. So according to our study, we think they at least use 7 connected capability I introduced previously. I think that's the reason they can make it success. Okay, next please. The next one is I want to introduce is BlackRock's Aladdin. Aladdin built a risk analytic as a service, as you can see from the slide. But I don't think it's just risk analytic as a service. Okay, you may know BlackRock. BlackRock for Aladdin is kind of a investment platform. Aladdin, what's Aladdin function? The platform is try to help those investment manager to use this platform to drive their day-to-day investment. Also, they also open Aladdin to end users, allow them to tap into the same technology. They can access Aladdin to get a lot of portfolio and the data as well. And in order to echo climate change and the sustainability issue, Aladdin also integrate new ESG data. They team up with MSCI and the sustainability analytic into that platform. Okay, they also partnership with another startup company. We call it Clarity AI. It's a tech-driven sustainability major startup. According to my understanding, Clarity AI also work together with Porsche, the car company. Yeah, so it's quite interesting. It's a quite interesting company. Okay, so I think those kind of a strategy alliance to really form Aladdin's specific position during the competition. Okay, so another angle I want to say is that sustainability is not only evolving customer trend driving the evolution of Aladdin's platform. Many institutional investor and wealth clients, for example, they also need more data to get more market information to get more profitable investment return. So in that sense, Aladdin also try to team up with another company. We call it eFront. Yeah. So those are the BlackRock, Aladdin's ecosystems strategy. So ultimately, we think this focus on BlackRock's they focus on delivery consistent and timely data for investor in what has enabled BlackRock's Aladdin platform to remain relevant and value focused. That's the reason they succeed. They success. Okay, next please. And the last one, I want to introduce the Taiwan case. I'm quite proud of this case. It's Taiwan Cooperative Banks. As you may know, we call it TCB. TCB Banks, the biggest shareholder of TCB is Taiwanese Ministry of Finance, which means some shares are from Taiwanese government. So one of TCB's key vision is to help growth and the stability of Taiwan economy status. Especially there are a lot of small medium companies in Taiwan. How to help them grow? How to help them with a healthier financial situation? Those are all TCB's mission. Okay, so in recent years, under TCB's management team's leadership, they never stop their road of innovation. So I just try to lead some of their tasks, some of their actions from the right-hand side. So for example, they have built a 36 zero-degree customer DB for data-driven decision-making. They also set up a lab, an innovation lab. We call it CoLab, C-O-L-A-B. CoLab means you're always working together with your client. You always co-work with your partner. You always co-work with your employee, etc. So under CoLab, they successfully generate 100 patents in recent years. They also use AI and RPA for internal process efficiency. And currently, it's quite interesting. TCB put a lot of focus on the topic of Trust 2.0. The philosophy of Trust 2.0 is more about how to help minority group, how to help those vulnerable group, how to help them to have a better and well-planned life, especially for those elder people. So under the leadership, under the plan of Trust 2.0, TCB co-work with hospital, co-work with construction company, and many counterparties as an ecosystem. They make banking not just a bank, not just a financial service provider, but a total care service provider. I think which is a very great leading example under ESG trend. That was the story of the TCB Bank. Next, please. So this is the presentation of today. So in the last page, I would like to use Jeff Bezos' quote for today's ending. Yesterday's wow space quickly become today's ordinary. I just want to encourage you to be innovative. Try to learn, try to fail, try to learn from fail, try to work together with your partner, try to find the best answers. The most interesting thing is there's no standard answer. we have to find it. We have to redefine the question. We have to find the answer together. Thanks for your time.
Thank you very much, Wayne. That was a very insightful presentation. Unfortunately, I understand that you have to leave due to another engagement, but we are very encouraged by more than 200 participants who have logged in virtually. What we will do is, when we finish the other two presentations and get into question time, I also urge the participants who may have picked up some points from Wayne's presentation, if they have any questions they would like to raise for Wayne, please place them on Q&A. I myself have 3 to 4 questions which are specific to Wayne, which I have already shared with him, and he has kindly agreed to respond to any questions which are posed to him, which will also be captured by the ABA Secretariat and incorporated in the recordings once the session is over. So thank you very much again for your time and insights, Wayne. A very insightful 30 minutes. I wish you all the very best.
Thank you.
So we move on to the next presentation from Christophe Uzureau, who is the Vice President Analyst of Gartner.
Let's start. So we wanted to use that session to explore a topic that is still very much hype, the metaverse, and to become a bit more practical on the implications for the banking industry. And the idea is to start to give you some pointers into what you could do with the metaverse and prepare now. And we have to take a step back. We know that the metaverse today doesn't exist, that there are many different emerging models that are approaching. And we have to start to think about what to prioritize your investment to respond to that still quite uncertain development. So to do this, we're going to first look at a definition. This is the generic definition we use in Gartner to start with our clients. We define the metaverse as a collective virtual shared space created by the convergence of virtually enhanced physical and digital reality. The metaverse is persistent, providing enhanced immersive experiences. That sounds very nice, but let's decompose a little bit that definition. First, the easy part. The metaverse is persistent. It just means whether or not you interact with the metaverse, it continues to evolve. It's an own living world, virtual world to that extent. And that's nothing that new to that extent. But it gets a bit more tricky in other parts of the definition. Immersive. What do we mean by immersive? What level of immersion? Do we really need everyone to wear virtual reality headset to have an immersive experience? Are there other ways to be immersive? What are the costs to customers for that level of immersion? We need to look into that in more details. But another element is more problematic in our view. Is the definition imply it's a collective virtual shared space? Does it mean it's collective in terms of users, interactions? In terms of collective, in terms of how we participate in the creation of a metaverse, in the governance of a metaverse? And that's one of the challenging points. If we look more closely into some of the development in the metaverse, realize there are very different views of how the metaverse should evolve. If you look at the $27 billion operating loss so far of the metaverse division of Meta, and they achieve around 200,000 monthly users according to the Wall Street Journal, we start to wonder, is it just a timing issue, or is the metaverse developing not really aligned to customers' business demands? At the same time, we start to see that some of the metaverse out there, or emerging metaverse, I should say, like Roblox, are generating interaction for 54 million daily active users. And they also have 10 million contributors creating content for other participants. Zepeto, based out of South Korea, but operating globally, has 2 to 2.6 million creators. They are creating content on behalf of other participants, selling digital assets to other participants. So what you start to see is a different vision of some emerging metaverses tend to involve the participants in a very different fashion. They're much more actively involved, so to speak. And if we go back to the essence, to the first time the concept of the metaverse was mentioned, on the left of that slide in the novel Snow Crash, it was very much defined as an environment created by multiple participants, a large number of participants, not by one company or a group of companies. So very different vision than what Meta is putting out there. That's all very nice. What are the implications for bank? So what? So what I'm planning to do is to look at three main impacts, so to speak, and deriving some specific recommendations out of those impacts. We'll first look at the new engagement models that are being created by the emerging metaverse. And we will start to look at how banks are reacting to this. And I will tend to spend a bit more time in the recommendation highlighted in orange here, like embedded financial services. Why is it important, those new engagement models? Secondly, and I will say even more importantly, we look at new digital asset classes. What is the opportunity for banks? And here we discuss why the fact that the metaverse is immature is actually a great opportunity for the banking industry. And finally, we spend some time on introducing new business models, some of them more aligned to Web3, and we discuss what it is in the first place. But most importantly, why is it impacting the nature of your customer base as a bank, and how should you prepare for that? So let's start. Let's explore new engagement models. And to do this, let's actually travel to South Korea. So let's do this. So the example I want to use here, and I didn't choose South Korea at random. You have to realize that in South Korea, the government has been pushing for the Metaverse Alliance and has created incentives for industries to collaborate with each other. And that has generated some interesting new types of partnerships. And as Wayne mentioned in the presentation, that kind of dynamic partnership is very important for the future of your digital transformation. In the case of Hana Bank, what they've done is they partner with Zepeto, which I mentioned before. And they created a digital twin of their training center in the Zepeto digital environment. That was very useful during the health crisis to support onboarding of new employees and training of existing employees. So it also contributed very strongly to building that digital workforce. But very interestingly, it also created an ability for Hana Bank to experiment with different interactions, employees to employees, to explore new customer scenarios, to think about what could be the next generation of services they could provide to their customers. And very importantly, this is also a very strong message to the market in terms of talent acquisition, meaning we are innovating, we will give you the tools to innovate if you join Hana Bank in the first place. The second point, which I find interesting about Hana Bank, is they are adopting a multi-metaverse strategy. so to speak. As I mentioned, we have kind of a fragmentation of metaverse environments. And what a bank has decided is to operate across different metaverses. So they also operating in the sandbox, a metaverse built out of blockchain technology. So very much part of the Web3 types of emerging metaverses. And here it's more about to try to discover the new need of customers. What are those customers interacting in the sandbox? We tend to be more gaming type of customers. What are their requirements? Does this have implications for how we should design product and services? Could we actually embed financial product and services into those new environments? So we start to see embedded finance as a response to the demand from the metaverse. And one extra example to bring that point home is Industrial Bank of Korea. Industrial Bank of Korea has creating, I should say, the Dottery Bank account with the emerging metaverse called Cyworld. And the idea is not to create a fully immersive branch experience. As you can see from that capture, they are just marketing a new reward programs that reward the Dottery Bank account customers with some rewards every time they make transaction with a digital currency used in the Cyworld digital environments. They are trying to capture more data on the transactional activity of those notably younger customers. And that could be quite powerful to understand their banking habits, to maybe create an alternative credit record. And the other point we should probably realize by now, when you look at the graphics I'm showing you, they're not really about perfect 3D graphics. They're not really about fully immersive environments. It's much more about creating engagement with customers, embedding financial services in different environments where your customers are interacting with, not replicating a perfect digital twin of your branch channel. Now, I started to talk about digital asset, and I mentioned that the sandbox is built on the blockchain. More specifically, every single piece of land and asset in the sandbox is documented through a non-fungible tokens. In other words, a digital record created on the blockchain, which involves a smart contract. So a computer program that enforces some rights and obligations related to the use of that asset. And as a banking industry, you really need to get used to the different types of standards. I'm just putting a couple of examples here, so-called ERC, which stands for Ethereum Request for Comment. And some of them are here to define if you share that asset or you sell that asset, how much revenue you get if the person you sell that asset to will resell that asset. Also, we've seen recently the emergence of ERC 4907, which basically provides a way for you to let that digital asset for a specific amount of time, and the smart contract is used to manage the terms and conditions. I just wanted to give you that brief intro, just to level the playing field before we get into more discussion on digital asset. Another example is just to show the interesting thing happening here. Let me use that slide to focus a bit more on the DBS one. What is interesting here is, as Wayne mentioned, one of the priorities of CEO is very much to drive the sustainability agenda. And DBS have started to use the metaverse to do exactly that. So they have created their kind of a DBS word, which is very much focusing DBS better word, I should say, to be more specific. We are using this to promote companies which have been creating solutions which are positive toward the environment. And that's in itself quite interesting. They're trying to experiment and see if they can reach a new audience. But what I find interesting is the link between DBS, Better Word, and the Life Better sustainability app. So the app is here to nudge customers to become or to make more positive contribution toward the environment, and also to invest toward sustainability funds and so on. So you can see that there is an attempt to try to link the two. How can I actually promote certain companies, drive investment related to those companies, and promote sustainability. So again, it's not about creating a complete new channel. It's about seeing how can I embed existing services and application into those new environments. So connection across different channel environments are very important here. Now, we talk a bit about NFTs. It's time to go to talk about digital assets and why it's important here. So the key recommendation I want to make, to go straight to the point, is you have to make digital business assets portable. This is one of your number one opportunities. Why is that? Let me give you a bit of background using that model in a superficial fashion, but just to give you the fundamentals. We are in the middle of a transition, the so-called transition between Web 2 and Web 3. And before we look into the differences, the thing you need to be aware of is this transition is supported by another transition from a blockchain perspective. At the end of the day, blockchain is the infrastructure, the protocol supporting the development of Web 3, but not any type of blockchain. We're talking here about blockchain complete. In the financial services industry, we've seen the use of blockchain for specific use, mostly related to immutability, traceability, and so on. And it tends to use blockchain inspired. And blockchain inspired has some value. Let's not neglect this. But blockchain inspired tend to be built around three components, like distribution, the ability of a node of a network to have the same access to a ledger, encryptions, and immutability. And that clearly has improved the certification of document, KYC, and so on. The real transformation happens when you start to pay attention to tokenization, the ability to create a digital record related to the blockchain, which can represent an ID, an asset, monetary value, and so on and so on. And most importantly, to decentralization, the use of a consensus mechanism that enables the participant of a network to have a say in the governance, in the evolution of the platform. And this is actually what makes the difference between Web 2 and Web 3. If you look at Web 2 today, at the end of the day, the dominant business model tend to be the digital platform business models. Digital giants, such as Meta, Amazon, they treat you like a user. You participate at a certain level, but you have zero impact on the terms and conditions on the governance. Conversely, as part of Web 3, thanks to that level of decentralization, that consensus mechanism, you have a say in how this is going to evolve. You have a say in terms of how you want value chain to evolve in terms of its level of programmability. That's actually something as a bank you're going to have to get used to. Some of your customers, retail or businesses, are increasingly going to be able to reprogram or program different types of payment financial services value chains. How do you actually take that into account? How do you actually support that in a certain way? The second point I want to make, and I will spend more time in the third section exploring this, is very much related to new business models. I'm throwing at you quite a lot of acronyms here, but the point I want to make is when we talk about play to earn, build to earn, share to earn, and so on. We are basically saying that thanks to Web 3, there's an ability for customers to actually take ownership of those business models. It's not a digital platform. They can actually define the rules. They can participate in the evolution of those rules, of those terms and conditions. But really change the nature of your customers in the banking industry. And another important point is, as you probably guessed by now, because I keep saying it, we have a high level of fragmentations, which if we have fragmentation, we don't have a metaverse, because the metaverse is supposed to be fully integrated. We're supposed to have portability of data, of asset and ID. And it's clearly not the case today. Today, we tend to have many possible candidates to become a metaverse, from digital giants, from government-sponsored type of metaverse, from the so-called industrial metaverse, which imply that, for example, it is here, like companies are exploring how can I use my digital twins in order to actually transit toward the metaverse, make it more open, increase the collaborations with customers, with suppliers, and so on. Not just in a restricted fashion, in a much more open fashion. And as we discussed before, gaming industry is also a very strong candidate to create some metaverse environments. And actually, you could argue the gaming industry is the most interesting right now because they're trying to actually improve connectivity, connection across different different gaming environments. So let's get further than this and let's get a bit more practical on what's happening in the market today. But the key is we think because there's no metaverse today, because of the high level of fragmentations, there are opportunities for banks across identification, payment, exchange, and actually like a custody services as well. And you may have to actually accelerate your plan. This is an example from a company called Zelf. Let me highlight them here, Zelf. And they position themselves as the metaverse bank. It's a bit early to say that, but that said, they are trying to respond to the requirements to improve portability of digital assets and supporting transaction across metaverse environments. They created a kind of a payment gateway service integrated with some social messaging app, such as Discord, and they're helping like customers to buy and sell different types of gaming items. So we're trying to support that both a transactional capability, but also portability across different gaming environments. The other point I wanted to stress, which I found very interesting, they're also trying to use the gaming transaction, your gaming history, basically, as a way to create an alternative credit record. And that's important. I mean, as Wayne mentioned, you have to have strong data capabilities. And that implies looking beyond the silos you have today. You have to think about the specific customer environments and thinking about like those gaming environments as a way to better understand your next generation of customers, their credit worthiness, what kind of product and services they're looking for. And that said, I don't want to say that banks are late. Some banks actually have been pretty aggressive in that space. So let me use the example on the left here to illustrate that point. JP Morgan Chase has been promoting the Onyx digital platform for quite some time. And at first sight, when you look at the lounge they created in a metaverse or emerging metaverse called Decentraland, that's that one. The first time, and I've been there before, it's a little bit weird, to be honest. You have a tiger moving around, you're wondering what is happening here. But more interestingly, if you look beyond the surface, it's interesting to see that actually JP Morgan Chase has been positioning all the capabilities they have today, foreign exchange, payment services, custody services. They're trying to understand what are going to be the new requirements of those customers who own virtual land, who own real estate in the metaverse, who own different types of the NFTs, digital assets. What are the ID requirements? And recently, they make an interesting investment, strategic investment into Tilia. Tilia is actually not a new company. Tilia was the payment engine, still is, of Second Life. You could argue the first attempt to create a metaverse. And since this company has reinvented itself to actually start to become like the payment engine of the metaverse. So you start to see a lot of movement in that space. And I think payments here is very interesting to explore because, as I mentioned, some fintech are getting more involved. And also, as you can see, like there are some existing solutions that banks could leverage in that space. Now, we start to talk about Web3 and the implications. I'm very conscious that talking about Web3, it's a very difficult to define. And I started by talking about Web3 and introducing it as kind of in the contradiction as a challenge to Web2. But let's use another way to actually introduce Web3. I'm going to use an example for so-called play to earn model. And I would actually, it's a recommendation. If you really want to understand Web3 and the application, spend some time, join one of those blockchain-based games. Not to spend money, but just to experiment with the environment, to understand that you're not just a user, you're a very active participant. The example I'm using today is called, like this, comf.io. And it's not very often we can talk about spaceship fleet management when attending a banking conference, so I'm going to enjoy the opportunity. To do so, I'm going to use some workflow to make it much clearer. So the basic of the game is pretty simple. You own a spaceship, and that spaceship is actually a digital asset. It's based on those NFT standards on the Ethereum blockchain. And the idea is you have to get your spaceship close enough to an asteroid, and then you can actually mine this asteroid and get some tokens as rewards. So you have a combination of a fungible and non-fungible tokens. So it's actually quite an interesting game to understand the concept of different types of digital assets. But what is very Web3 about the approach is that other players can request to get closer to that asteroid. So for example, player 2 say, I want to be pulled closer to that asteroid. And I can charge them for doing this. I can use my pulling power, so to speak. And doing this, because we are in a Web3 environment, I can actually define which fee I want to charge. It's not the digital giant deciding, it's myself as a player. That's the first point. The second point is every single participant can join the Galactic Council. And this is a very important illustration of what is Web3. It's about governance. Basically, I can vote to any proposed change to smart contract. I can vote to how I want the game to evolve. And that's a fundamental concept, because if you extrapolate this to all the discussion we have on the metaverse, it means that when you start to be in a Web3 environment, the metaverse is not created by a given company or group of companies. It's created via the participants, become creators. That's the fundamental foundation of Web3. Now, gaming is very interesting to learn about. It's an interesting revenue model, but let's look also at the impact on the real world. At the end of the day, the metaverse is not just about online. So let me illustrate this. Let me illustrate these online-offline connections. I briefly mentioned before Zepeto, and Zepeto is very much like a good example of this. They enable some of their participants to become creators, and as you can see here, they can create some wearables that other participants can buy, and the avatar can wear those wearables, and the user gets rewarded for selling those items. Now, if we translate a bit more to Web3 environments, we start to see the emergence of this build-to-earn model to a new level, so to speak. So it's not the case yet, but RTFKT has been acquired by Nike, and it could be part of the next generations. So I'm combining here different elements from the perspective of the potential impact. But we have seen the ability of RTFKT to create wearables, register them as a non-fungible token. And the idea here is every time someone could use the Nike website, the Nike terms and conditions, the Nike platform, they could create a new design. And that new design could be actually registered as non-fungible tokens. And every time other Nike customers will acquire that wearable for their avatar, I will get some revenue thanks to the terms and condition recorded through the NFT. That's interesting, but not that interesting. The next stage is much more interesting. We start to see some of the customers, as illustrated by this capture, they are actually using Snapchat here to test how those wearables will look like if they were a real pair of sneakers. So now you have an ability through RTFKT to actually turn those digital wearables into a real pair of shoes. And from the Nike perspective or any other manufacturers, what is interesting is I have an existing demand validated. I also can actually use this to improve my supply chains linked to the demand. But most importantly, those customers that benefit from the development and the sale of those NFTs, they are going to become my collaborators. They are going to promote the design. They are benefiting financially from that design. So build to earn is a very important concept to have in mind when you look at the metaverse. And the reason I'm mentioning that as well is because by definition, those are new types of customers. They're not retail, they're not yet SMBs, they're in between. So you're going to have to rethink your customer segmentation model. Now, last slide here. So the other model I want to introduce, and especially because Wayne mentioned the importance of data asset, data monetization, and so on. And I talk a lot about customers model, but there's also this concept of industrial metaverse. And there are some connection between the industrial metaverse as well as a more customer-oriented metaverse to that extent. And you could argue that increasingly they're going to blur if we are going to have a real metaverse. But I want to go back full circle and go back to South Korea here. And I found interesting, we looked at Hyundai in more detail. So Hyundai has multiple projects. One is very much linked to the evolution of a digital twin, to use the metaverse to improve the management of their production line. They also have created the NFT community. It's mostly about promoting their brand and introducing new concepts. But when we look at both of those and discussing those concepts with clients, we start to think that there's maybe an opportunity here to think differently about data management. Let's imagine that you have your car, and your car is equipped with a lot of sensors, Internet of Things, and so on. And this could be used to create a kind of an avatar, which should be visible in emerging metaverse, which represents in real time the state of your car. And you could actually, using a non-fungible token, you could actually give or not access to that kind of a car avatar, to that data, those data points, give access to an insurance company, to a bank as a customer, which could pre-authorize a loan to buy the next generation of car, because they will have access to the real data to that extent in terms of state of your car and so on. So it's just an example, but you start to see that there's a lot of that. Metaverse also open a way to also make a flow from the physical, the real world, to the digital world to create new business models such as share to earn. So what I try to illustrate in those couple of illustration is it's not just about the virtual world. It's a back and forth between online and offline that is very interesting to capture as well. And so if I summarize a little bit like that discussions and stress a couple of important points, there's a lot more to say, clearly, and we're still at the very early stage. There's no question about this. But if I had to recommend like 3 key action on your side, I think you have to look at this first into an extension of your embedded finance capabilities. It's not about, again, replicating perfectly your branch channels. Most customers don't care, and they're not going to buy a virtual reality headset to do something that they can do in another way. But if you can embed financial services into all those different environments, therefore adopting a multi-metaverse strategy, like to Ana Bank, then you are like making the right step, and you're actually reusing what you already have. It's an extension of what you have. So that's the first point. I still think the most important opportunities relate to new digital asset classes. There's no metaverse today because there's a lack of integration, portability of assets, including ID across different types of environments. As a bank, you have an opportunity to bridge those gaps. That's your opportunity. I'm not saying it's easy, but that's clearly the main opportunity. And finally, as we discussed, new business models are changing the composition of your customers. You have to prepare to deal with new type of customers. You have to revise your credit scoring capability, risk management, and so on, and your segmentation model. So I think even if the metaverse doesn't exist today, there are enough indications and pointers for you to start to take action and start to experiment. So I think like my key message is actually very similar to what Wayne well said in his previous session is you have to keep experimenting, failing, it's part of the game, but it's really the right time to start experimenting in the metaverse today. So thank you very much for listening to me, and like we'll talk later during the Q&A sessions. Thank you very much.
Thank you very much, Christophe. That was an extremely insightful 40 minutes. I personally learned a hell of a lot in the last 45 minutes. And I think there is a complete ecosystem out there, which I think is an opportunity for Asian banks. The challenge and the issues is how ready is the ecosystem to engage the conventional system, and how does one manage some of the challenges, which we will discuss during Q&A time. We will now move on to the final of the three presentations by Jaslyin Qiyu, the Head of Client and Digital Channels of Marketing, Citi Bank, Singapore. Jaslyin has done a pre-recorded presentation which will be broadcast by the Secretariat in the next couple of seconds. And once that is finished, I will lead the Q&A session, inviting questions from the audience. So please bear with us for about another 20 minutes or so while we listen to Jaslyin.
Hi, I'm Jaslyin, and I oversee Citi Bank Singapore's client marketing and communications, including fraud and crisis comms, as well as the digital capabilities around the internet banking and mobile banking platforms. I'm happy to be invited by the organizers to actually share a topic that's close to my heart, which is around how we can all create a safe yet agile digital banking ecosystem. With the acceleration of all things digital, especially the use of mobile for even the most personal transactions that involve money, we have also actually observed a rise in fraud cases recently in Singapore. This seemed especially prevalent coming out of the tail end of the COVID-19 pandemic, at least here in Singapore. And I'm not sure if everyone is aware, but in December 2021, while everyone was winding down to celebrate Christmas and the year-end festive season, banks here were suddenly kept even busier than usual, thanks to a series of coordinated attacks on one of our 3 local banks, whose name I shall not mention, except that it starts with an O. All I can say is that it was indeed an oh dear moment for them and for us fellow banks, because this incident actually saw about an estimate of SGD $13.7 million in financial losses amongst close to 800 of their customers, which the bank eventually took full responsibility for by compensating their customers for the losses. So yes, a lot of lessons learned from there, which I will touch on in my segment today that covers across trust, security, and experience. The bank fraud mentioned earlier on was not where it stopped, unfortunately. The scammers only got bolder in their attacks and got even more creative in their approaches. For context, phishing links were actually sent disguised as their primary banking provider's identity, and most of our phone devices actually tend to group similar messages under one sender group, and many consumers thought it was sent by their own bank, whom of course they would trust. Therefore, clicking the link brought them to a phishing site, which asked for their personal banking details, and as a result, compromised their own banking account login information. It was a chaotic period as call centers were flooded, branches were flooded, as people desperately tried to find ways to disable access to their accounts or change their passwords, which apparently were not as swift and seamless as it should have been. And so the breaking point was reached, and the regulators stepped in and decided that all banks in Singapore needed to stop sending out emails and SMSs with clickable links as what they thought was a good interim stopgap measure to protect the consumers from clicking on phishing links. So this brings me to the point on trust and why it's all about trust, and why trust is dependent on not just one bank, but all banking and financial services providers to maintain and uphold, which we'll touch on in the next slide. As you can see, it's not just the bank's reputation at stake here, but our entire banking industry reputation as part of the broader picture. And if we want to position Singapore as a safe and secure financial services hub, we need to be seen as being trustworthy by both local and foreign investors and consumers alike. After all, it takes years of efforts to build consumer trust, which is also an important driver of brand reputation and brand value, which takes only a few such scamming incidents to destroy. This is also likely the reason why that particular bank decided to bite the bullet and pay the lost money back to their customers as part of regaining trust and building confidence in their banking security measures, processes, and platforms. In this case, the short-term benefits simply outweigh the longer-term consequences for them, as it also suggests that banks might not be as prepared for such coordinated and syndicated attacks as they think they are. Who knows what else the scammers might do? And who knows what consumers might also do out of desperation, short of closing accounts and putting hard cash stashed under their pillows like what their parents did in the old days. So how can banks regain consumer trust in such instances? As you would see, the stopgap measure of seizing clickable links on some of the bank's favorite communication channels like emails and SMSs are all but a band-aid measure to give everyone some time to gather a task force to tackle this collectively in hope that consumers can also wisen up, stop clicking on random links. But is that enough? Well, if you follow the news, you will see more of such scam cases of fraudsters pretending to be police officers, tax officers, and other government officials, and providing more phishing links or conducting scam calls under the guises of such official comms to try and get the customer's banking details, and they still succeed. So this brings me to my next point and question as well, around who ultimately is responsible for security. Is it banks? Is it regulators? How about telcos when it comes to SMSs and fraud calls? And how about customers themselves? So to me, and where we eventually landed is, it is essentially everyone's responsibility to be safe and secure with your personal details, how you use it, and where you use it, as well as how you store it safely and securely. Because the truth is, we cannot manage this alone. Everyone plays their own part. On a broader level, as part of the banking ecosystem, banks need to work with other banks, financial services providers, regulators, public agencies, telco, as well as their tech and merchant partners to understand, share best practices, use cases, and keep abreast of the latest scam trends. From a banking perspective, we need to also scrutinize and review our current processes and whether these are as agile and seamless as they should be. Some questions banks need to think about and consider include: how easy is it for your customers to say, disable their account, change their passcode, cancel their lost or stolen card, or adjust their payment limits quickly? Do they need to do it through a call center each time? And if so, how well resourced and how well staffed is your call center to manage such cases and volumes when a similar syndicated attack happens concurrently? Do they need to wait, or is it immediate if they request to cancel their account or update their payment limits? What other channels and avenues do you have available to empower and enable them to self-service and self-help? Can they do this all via your internet banking and mobile banking platform? Can your system and network support such voluminous access all around the same time without crashing? When was the last time you stress tested this scenario? When was the last time you conducted a scenario role play as well to see if there are gaps in your current communications and resolution processes for such crisis situations? Does everyone know the role they play and the turnaround time that it's feasible for each part of the process? In this ecosystem of shared responsibility, collaborative education is also key. Everyone plays a part in educating the customer on ways to protect themselves from fraud and scams by being aware of the different fraud scenarios that can happen to them. But again, is that enough to placate unhappy customers and help build trust? During the crux of dealing with scam incidents and coming up with protective and preventive measures, banks actually had to start implementing a few functional settings and security settings, including a minimum time frame before effecting changes to a customer's account, including adding a new payee, lowering payment limits for P2P transfers, including Pay Now or instant transfers, account access disablement, timely triggers or notifications when actions like these and other account transactions are performed. This is on top of other features that can already self-help via our internet or mobile banking platforms, like report a lost card and locking their card. Some of these features essentially also mean customers can no longer transfer large amounts of money without first changing their payment limit settings. And to change their payment limit settings, they need to wait for a day or two first before their instructions take effect. As you can imagine, from a customer's perspective, it can pose inconveniences, especially during times of urgent financial transactions needing to be done. It can also cause them to distrust banks more, as they start to perceive banks as being inefficient with the way they are managing their accounts and their banking instructions. It might look like a bit of a chicken and egg situation where you almost think there's a trade-off somewhere needing to be made between the experience, the security features, the tech enhancements, and the investments to be made, right down to whether you have the right people behind who knows how to maximize these capabilities. To address that, it's important for organizations to break their focus back on three main things: people, process, and the technology, and revisit the approach for each. For people, education and prior notice are crucial to both create awareness and to educate them on the rationale for these measures. Plus, besides educating them about various possible scam scenarios, we started educating them and keeping them abreast at least a couple of months ahead of time. Every time a new enhancement affecting their banking experience is going to be implemented. To further support the transition, we also beef up information touchpoints and implemented an educational series teaching them ways to self-help, where to access the features, and how to better protect our accounts and banking details. Besides ensuring that the information is accessible across all our channels, including our website, mobile, in-app platform, call center talking points, branches, social platforms, emails, and push messaging, we also needed to ensure the communications can be triggered in an agile manner within as short a turnaround time as possible, especially during times of crisis. This is also the process part of it to be addressed. For some banks, it might mean re-looking at your current customer communication tools and processes to determine if you need to change out some of the legacy processes and practices that can no longer keep pace with such scenarios. For others, it's the technology part that needs revisiting as well see if current technologies used to enable your customer communications, banking communications, and banking transactions are still as agile as they need to be in responding to your customers' needs in a timely fashion. Are you able to empower them to take actions on their own? Are you able to inform them in real time if something happens to their accounts? Or are you still struggling with manual processes requiring human intervention? To say, trigger an alert, send a notification, or have them go down in person to validate their identity before you can accept and act on their instructions. The end goal, I believe, is to ensure that their overall banking experience remains secure, yet as seamless as possible within the boundaries of what is allowed, versus what it takes to abide by local regulations and still maintain consumer trust. Ending off my segment, just to recap a few key takeaways at my end on how we can continue to thrive in a safe yet robust digital banking ecosystem. Educate the customer as well to take responsibility for their own banking security. Work closely with other banking and service providers to exchange best practices and adopt a shared responsibility mindset towards customer and banking security. Customer education should be an evergreen and always-on program in your organization. When designing processes and enhancing your banking features, look towards empowerment where possible, so customers don't need to only rely on a few limited offline channels to protect their bank accounts. Think like a customer first about what makes most sense. It's not always the most expensive technology or platform, but rather how you use it, how you enable your employees and customers to use it, and how well your current processes are supporting it that makes it a worthy and sustainable investment in the long run. And with that, I thank you for your time and for listening to me. I would like to hand the time back to the organizers. And if you wish to connect with me offline with any questions that you might have, or just to discuss any ideas that you have on how we can all come together to prevent fraud and educate customers, feel free to connect with me via LinkedIn. Thank you.
So that concludes the three presentations, ladies and gentlemen. We now open the session for Q&A. Christophe, in your presentation, there was a very interesting concept of changing the behaviors of a consumer, from consumerism to what you call, I think you called it prosumerism, right? Prosumer, which is very exciting. I think it's probably very apt for sophisticated markets in this ecosystem. But you and I live in a real world where roughly 40% of the population lives today on a daily income of less than $5.50. So how does one reconcile this upside opportunity with the need for financial inclusivity when we look at triple bottom line? How does one look at that? Your thoughts?
Yeah, no, thank you. Thanks. I think it's a very important question, because I think we, especially, I mean, if we take first the context, I mean, it's go beyond the metaverse, clearly that question, but if we take the concept of the metaverse today, if we carry on a vision of that very immersive environment that require expensive headset, perfect like connectivity, clearly it's going to be very difficult for supporting or using that model to support like a large number of economic participants, so to speak. So there's clearly an issue there. At the same time, I mean, not limiting this to the metaverse, making the link. When we look at prosumers, I mean, I think it's we should credit that a lot of participants in Southeast Asia, in particular like Southeast Asia, Indonesia, in the Philippines, and so on, they are actually quite. I mean, the Philippines, for example, they were geared toward like some of those gaming activities. It's become actually, in certain cases, a challenge for regulators, as some of those customers are starting to become prosumers themselves in terms of how they rely on model like play to earn to generate extra revenue. So there's clearly an appetite, and I think it's not just a question of having a mature market and spending like $1,000 on a virtual reality headset. There's already some ways to enter that market and creating like some momentum from a consumer perspective. And I think the Philippines and gaming is a good illustration of this. The other point which I want to add to this is there's also, and I hear thinking beyond the metaverse and all the concept around Web3 and digital finance and so on, because it's been quite interesting to follow the example from the Banco Central do Brazil, so the Central Bank of Brazil. They have been looking into how to use some concepts which are kind of linked to Web3 and what I briefly mentioned related to programmable money to try to see how can they actually help and improve financial inclusion, especially with the farming community to start with. So we have, and it's only a pilot today, let's be clear, but we have a plan to actually, as part of developing a CBDC, so central bank digital currency, they try to attach and relate the central bank digital currency with the use of smart contracts to enable the farmers to actually commit a certain amount of production of agricultural commodity to commodity buyers, and using the smart contract to manage the process, make it more transparent, reduce the number of intermediaries, reduce the cost to the farmer, and so on. And the idea is if you do this, you create a more transparent market, and then the farmer themselves could actually obtain better financing before he delivers the goods to warehouse, for example, because the smart contract will make it clear that he has to meet its obligation to that extent. So I know it's getting a bit outside the metaverse, but some of those Web3 technologies are a way to strengthen existing, like not underbanked community to that extent, but they also create a point of entry and say like it depends on the market and regulators from a gaming perspective. And last point to support that question, I mentioned regulation. That's an important one because in certain case, the regulator is not too keen on some of those new digital currencies to emerge, and the play-to-earn model sometimes can create some unbalance, it creates some risk and so on. But at the same time, it has been quite interesting to see how it actually generates an extra revenue and sometimes a very important extra revenue for underbanked populations. And you could argue, and I make the link back to the presentation I did before, but if you pay attention to some of the gaming activity, the payments, the assets that those gaming assets that like underbanked population are acquiring, you could actually help and use this to create alternative credit record and to create some bancarization roadmap to that extent. So I don't think it's incompatible with the view we've been discussing around Web3 and Metaverse, except if we take a view of a Metaverse, which virtual reality headset, perfect connectivity and so on, which clearly it's not the priority for underbanked customers. It's how we're going to generate extra revenues. And I think we go back to those business models that can help. So there's the way forward. And I think markets like the Philippines are showing some interesting promise to that respect.
Thank you, Christophe. We have another question from Mohammed Jama. How to make sure that online banking and digital banks are free from money laundering activities and other financial crimes? A natural question. When you respond to this, Christophe, maybe also a particular reference as to how one handles NFTs, because NFTs are also becoming very popular today, non-fungibles, but there again, there is this risk or concern of linking money laundering. So your thoughts on that?
Yes, I can mostly comment from the whole debate on money laundering probably require like a more specialized expert than myself on money laundering and cyber crime and so on. But I can comment from a perspective of NFTs and digital assets to start with. I mean, there's no question that NFTs and NFTs marketplaces have experienced a lot of fraud and scam. There's no, I mean, clearly that's been a big issue, but there are ways to start to handle that. I mean, to some banks, I mean, again, I don't want to look like I'm promoting only soft current banks, but some groups in Korea are experimenting with enabling their customers to create an NFT through their mobile banking, online banking platform. And it's mostly an experiment to understand how to actually create a kind of or use the online banking or digital banking channel as a way to manage customers' different types of NFTs. Could be related to a photo, to some data, and so on. So you could take a more hands-on approach, but clearly customers would like to bring NFTs from outside to the banking experience. So there are like more technical solutions available, so to speak. It's fair to say that overall, we've seen companies in kind of a forensic domain but are actually getting more and more sophisticated in monitoring the flows related to NFT and digital assets. There are still some weaknesses, but it's clear that if they're actually capturing what kind of templates and approach different cyber criminals are using, and they start to actually help the different marketplace participants, digital asset wallet providers to react to those threats. So the ecosystem itself is evolving. It will never be perfect because we have the same issue we have in cybersecurity in general. It's always a kind of a cat and mouse type of approach. So everyone's getting more sophisticated, but the solution have been improving quite strongly to deal with that ecosystem, which is getting more and more complex to that extent. The other side, to go back to this, is the problem is sometimes, and I take NFT, zoom in on NFT itself is complex because NFT at the end of the day is just a digital record with some terms and conditions. What is important is what type of asset are we talking about? So here, the challenge is often that there's a lack of a harmonization or clarity in terms of how to deal with different types of assets. So for example, in the UK, if an NFT represents an art piece, an artwork of a certain value, then depending on that size, you have to go through a very specific KYC process, registration, and so on. So existing anti-money law apply depending on what's the asset related to this. The second part is also how do you record, how do you license the NFT providers themselves? And in certain cases, like in the Middle East, like in Dubai, they create an infrastructure to register like some of the NFT marketplaces to create a kind of a stronger type of KYC AML process. So the regulator has a role to play in filtering the market. But let's be clear, you will always have NFT marketplaces that operate outside of those markets that cater for like a kind of a very, more like a black market type of activity and so on, and sometimes focusing on money laundering to that aspect. So I think they are like, it's not a perfect answer to that question. I tend to focus more on digital asset side. I think, to be honest, there's less and less excuse for banks not to participate. The tools are getting better, and the banks themselves could develop tools and provide them to the marketplace. The regulators clearly have to work on clarity. I think we have to stop treating NFT as just one type of digital assets. It depends what they represent, and that could be linked to different types of legislation as well. So there's clearly kind of a lot of work being done in terms of orchestration here. So that will be my first attempt at answering that question.
Thank you very much. Thank you very much. And I guess just to add a couple of points, the NFT market has two elements. You, on the one hand, have NFTs traded in an organized exchange, where very often it is easier to implant the proper AML framework. But on the other hand, you also have another vertical, which is the private label NFT market, which is traded off the counter. That is where I guess while the premiums are higher, the challenge in getting a proper AML framework is there. But that's probably a conversation for another day. We have another couple of interesting questions. I think the next one to you is from Carlos Tengiet. How quickly does the Asian market adapt to the metaverse, as there is a barrier to entry in terms of cost, infrastructure, and education?
Yeah, it's an interesting question because it's always depend on which vision of the metaverse. You could argue that the Asian market is actually quite advanced. I mean, a lot of the companies, like the Sandbox is created by Anonymika. I never pronounced that quite correctly, from Hong Kong. You have like a strong candidates like Zepeto from the South Korean markets, Axie Infinity, not really a metaverse, more like a gaming platform created from the Vietnam markets, been quite popular in the Philippines. There are also like some very strong regulatory framework on digital assets in Singapore. We have a vision of an industrial metaverse in the Chinese market, so a different approach to the metaverse there, trying to focus on development of physical product and services, improving supply chain. So overall, if we don't imagine the metaverse as this perfect immersive type of environment, I mean, Asia as a whole has been not only enabling some very strong companies which are creating, I would say, very strong engagement models, but also have a population that's getting used to those products and services to that extent. And I think like taking a more like a banking lens here, when I spend time with our banking clients, I mean, quite a few of them are already experimenting. And they're taking a very approach. What I like is quite a few of the clients I've been dealing with, they say, okay, we actually experimenting ourselves. We create, for example, an ability for us to get a couple of software engineers using Meta Horizon words, and they can experiment with the technology, give us feedback on the quality of the technology, and define whether it's useful or not to that extent. Or we use it for onboarding like new customers, or mostly I should say employees. We use it as part of some virtual like recruitment, like capabilities to attract talent and so on. So we're already involved in more of the horizontal types, and now they start to get more involved on the digital asset type as well. So I think we need to, it's important not to think of a metaverse as the vision from Mr. Zuckerberg to that extent. You have to actually more take a vision from your existing customers and how they think about the evolution of those new emerging environments. And you can clearly see that today there's already some interesting progress, and it's worth starting to get involved. And we're not saying that the opportunity is easy. I mean, the Sandbox is an example of a metaverse where a lot of banks have acquired some virtual land using those plot of land 3x3, so 9 small plot of lands. And they don't experience today a lot of interaction, to be clear. It's much more experimental. It's much more linked to an innovation lab. But it's a very important learning curve to prepare for understanding digital assets. That said, clearly, in terms of generating revenue and so on, most of the banks we talk to, and they don't expect like revenue or any like sign of identifiable revenue before 2026 to that extent. We need to have that transition. We need to have clarity from a regulatory perspective and so on. So I think as we still think about that date, 2025, 2026, as an important like transition. And the reason this is, I want to document this a bit further, is we take this metaverse opportunity not in isolation. We take this as part of what we call in Gartner the programmable economy. So looking at the evolution and creation of new types of assets, both in the virtual and physical world. And we still think like 2026 is kind of a good year of accelerations to that extent. So I think like we should see by 2026 some interesting like tweak in the business models, and we start to see a recognition of some interesting revenue during that year to that extent. Just to give you some timeline to be a bit more precise.
Thank you, Christophe. I'm going to attempt to respond to 2 questions if I come back to you. There is one question from, I think, Cecilia Gado. Is it mandatory requirement for a real-time fraud monitoring to all financial institutions in one of the effective controls to address cybersecurity crime? I guess the response to that would be, it would depend on each jurisdiction, depending on the regulatory supervision in each jurisdiction. But eventually, when we look at a licensed regulatory institution, one would have the ultimate responsibility when you engage into financial services that you have to take your own care. So whether you monitor it real time or offline, eventually the responsibility lies in you. And I guess that is where there is the opportunity for those smaller institutions who may not have the bandwidth to invest in this sort of capacity. I think it was Wayne in his presentation brought up of one of the three verticals, the interesting thing of banking as a service. When we look at banking as a service like the SaaS model, you then have somebody offering tailor-made solutions, including stuff like cybersecurity mitigation on a subscription basis. So the investment in capital expenditure, keeping up to date is all done by somebody else. You pay per click. So that is probably one way of mitigating it. And in some other markets, you have pooling of resources, and you actually bring the infrastructure like cybersecurity monitoring into a common SPV, and then you have a whole range of participants subscribe to that common SPV. So there are various models which are available in the market to combat cybersecurity. I hope that was useful. There is a question from Saad Abdirisakar. I hope I got that name right. How do licensing digital banks differ from licensing traditional banks? Is there a specific process or procedure to regulate digital banks? Again, I guess this will debate from a regulator to regulator in each jurisdiction. Maybe Christophe, from a Gartner point of view, you may have some insights, especially for markets like Singapore, which have already gone fairly advanced in digital space. Would you like to make some observations of that?
I can comment. I mean, it's been tended to be like a kind of as part of a. I mean, we've seen like basically every single not city but large cities trying to become a fintech hub to that extent. So they have tried to reach an interesting balance between like enabling new players to join, to create more innovations, to actually promote the financial services sector locally, originally, to that extent. So they tend to have maybe different approaches to how they do that. They need to show that they can do the trade-off between creating like fostering innovations, as well as like, of course, like dealing with the pressure from the incumbent banks to that extent. So I think like from a digital banks, we've seen different approaches in different markets. I mean, in certain markets, they tended to, you can get a license, for example, if you get more involved on the retail side, in certain case, more wholesale banking license. So we try to see which part of the ecosystem need more development. In certain markets, like they tend to look at what exactly is the contribution you bring. So, and they realize that a lot of those new digital banks, and the digital banks, I tend to like the term like neobanks to that extent, or new entrants, they tend to look at what do they bring to the market. Are they trying to support new propositions? And therefore, even if they tend to be more like a mono products, you give them a license, and maybe more limited license to start with, to operate, but they are actually improving competition in a certain domain. So I think there's been one of the area which we've seen some changes from that perspective. But to answer, actually, to better answer that questions, the licensing itself is one thing, but what's been the most important component is the access to the banking infrastructure. So licensing and give them a bit more flexibility who can join. They may not have the same capital requirements. For example, that's obvious, but what's been the most interesting and important part is goes back to the discussion open banking, open financial services, is how do you create an infrastructure where actually, if you're a new entrant and you come with one given product, for example, let's say I provide a credit line as part of buy now, pay later, and I want to start to become a digital bank, I could become a digital bank, but I could really benefit from open banking because then I can ask authorization of my customers to open up in terms of sharing the data, to give consent, and then I can improve my credit capabilities, and I can actually have a more serious play in digital banking side. So the licensing has been it's quite an important part, but I would say like it's only makes sense if you start to have this infrastructure of open financial services at the same time, because a lot of those new fintech and entrants, even they claim to be digital bank, they tend to focus on one specific area. If there's not that openness for open financial services, we're not going to be able to develop to that extent. So I think I mean, I'm diverting a bit away from the licensing question to that extent, but I see the open financial services requirement very important. Otherwise, you're giving license to a new entrant that is going to struggle to survive, and you're going to disappoint customers, and you're going to have to deal with some liability here to that extent. So I think that would be my answer to that one.
Thank you, Christophe. How is it really relevant for a bank who generally deals with accepting deposits and lending to know all the metaverse, crypto, etc.?
It's a very important point, but I think like when we talk about digital assets and so on, we're not talking just about cryptocurrencies. And I think I want to make the point clear that, like, to give you let me give you an example to be more specific. There's a lot of work being done right now around the discussion around health data. So on the one hand, there are discussions how, as part of the metaverse, you could create, for example, in a part of the health industry, a health avatar that represent all your health data in real time. So basically, like you could be using sensors, etc., whatever. And the idea of this health avatar, that could be supporting, for example, like your clinical trial, more decentralized clinical trial, and so on, that could support the health industry as a whole, insurance, diagnostics, training, whatever. But at the same time, you need to manage the consent. So some companies are working to using like a NFT, non-fungible token, as a way for you to give or not access to your health data. So it's not about the cryptocurrency, it's not about digital currency and so on. It's about using a blockchain to manage access to the health data to that extent. You may say, well, what's the point for banks? Well, in the research we've done in terms of customers' interest and perception of data services, it is very clear that banks are perceived in a more positive fashion than other providers as a guarantor in terms of how to manage sensitive data. And I think that's important for banks to realize that when we talk about digital asset, this is not just like a typical asset M1 and so on. You also have a role to manage those new health data. And it's not only about generating revenue from data monetization, to be clear, but if you have customers to manage to get better visibility on their data as a whole, you become a guarantor of that data and so on, you help them to manage the consent, that gives you access, I should say, to a specific context of customer needs. And that itself will impact like your ability to capture deposit and so on. So there is that element which is very important. Another element to combine to this is actually very much related to deposit and lending. A lot of the activities, especially of younger customers, as I mentioned, into those emerging environments, are going to be very important to feed into those like alternative credit rating. I mean, some of the first payment experience of customers are into those gaming environments. And that will have a strong implication in terms of how you're going to build a credit profile for your customers, how you're going to reach those customers and so on. So it's not about cryptocurrencies, to be clear. When we talk about like the role of blockchain and digital assets, it's actually very much also about how do you actually embed financial services to support those customers into those new environments. So you don't have to deal with cryptocurrencies to be involved. Some banks will, because they have a strong role to plug like the exchanges to that extent. But there's clearly, at least at a minimum, a role for you as a bank to get involved with those new environments to understand how your customers' consumption patterns are evolving. I think that's very important to actually support your future like demand for deposit and lending as well. I just saw a question from Carlos Tancat. He was asking about follow-up. Are there cross-border regulatory frameworks on the metaverse being formulated? And at the moment, I think it's not yet. And I think the answer I wanted to give is there is like the part of the answer is this, just to make sure there is a Web3 Foundation which is trying to start to answer that question. So from a technical perspective, the Web3 Foundation is trying to see how to improve like the connectivity across different emerging metaverses, and that could help to improve like regulation so far. But to be clear, to answer that question so far, again, everyone is trying to become a metaverse hub, and there's not yet any collaborations, but we can expect more collaboration between different metaverse hubs. It hasn't happened yet. Sorry, I just wanted to, it was a follow-up question. I just wanted to answer it.
Thank you again, Christopher. And this will end our second session of the conference. See you and thank you.
Bye. Thank you.